Hi everybody, welcome to the complete MBA course. Today we will learn about credit and debit and do an exercise to understand how it works. So let's start. Credit and debit, what are they? Well, in every transaction, the money is debited from one account from your COA and credited to another one. That way, accountants know where the money starts and when it goes for every cash movement, making everything much clearer. For example, here is the COA that I explained you in the last video. In one transaction, maybe you're using cash, which would be this account here, to buy a property, which is this account here. In that case, debit and credit will be one account is being credited and the other one is being debited. Now you understand that it's very important that you learn how to differentiate which account is debited and which one is credited. Many people think that credit is the account where the money starts, that would be this one here, and debit is the account where the money goes, which would be this one here. But that is wrong. To understand if an account is a debit or a credit, you'll have to check your COA and understand which one is being increased. Then apply the equation, this equation. An account is the debit if there is an increase of an asset or an increase of an expense. If you don't find any increase of asset or expenses, the debit is the one that decreases the equity, decreases the liability, or decreases the revenues. It may be a bit difficult to understand the first time you hear about that, but let's do an example and you will quickly get how it goes. Let's imagine that you're starting a company, for example, and you're making the accounting journal for the following activities. I put a lot of activities so that you understand all of the cases. What I wrote here is a list of what I think that a small company should do when it starts, from the moment of its creation. I've also created a small table here with some of the solutions already, because it will help us make things quicker. You will see that I'm putting you already the number of the account, as we learned in the last video, and the name of that account. But imagine you don't know them. I'll show you how to look for them too. So if you're ready, I will go one by one to all the transactions that we're having. Let's see. First one, 1st of January. Imagine that investors provide 5,000 euros to start your business and they're giving shares in return. So now we have to identify the two accounts being involved in this transaction. Because they're providing you 5,000 euro, your cash is being increased by 5,000 euro. That is your first account. If you look for cash, is here, is the 1.9. So you write here 1.9, you write here cash, and then you go to the next one. What is the second account being involved? If you remember from the last video, the second one is the shares issued, which is here, is under equity, and it's the 2.1. So the second account being involved is 2.1, and then you put issued capital, which is the name of an account. Now, you know that 5,000 euro are being exchanged, but which one is the debit? Here is where the equation comes from. The increase of the asset or the increase of the expense is the debit. Which one is the asset? Cash. You see, cash is under the family of asset. So because cash is being increased and cash is an asset, that is the debit. You go back and you put 5,000 here. Credit will be the other one, which is 5,000 on issued capital. You just did your first account entry. Let's go to the second one. 10th of January. Here the company receives 10,000 euro from a loan from the bank. So it is very easy to identify the first account being involved here, which is cash. You remember cash is 1.9 in our COA, so I put 1.9 and cash here. The second account being involved is loans from the bank. That's going to be, of course, on the family of liabilities and is the 3.1. If you remember, notes payable refers to borrowing from the bank. So that's the 3.1 borrowings. You write 3.1, and now that you've identified the two accounts being involved, let's see how much they're exchanging. 10,000 euro. Which one is the debit? Well, because you're receiving 10,000 cash and cash is the asset, cash is being increased, cash is the debit. So you put 10,000 euro on cash and 10,000 euro on borrowings. Remember, it's very easy to understand, an increase of cash is always the debit. So now you understand that increases of cash are always debit. Let's go to other ones to get more examples. So in 12th of January, the company purchases 5,000 euro in equipment using cash. Let's first identify the accounts. An increase of equipment. Where is equipment? Well, equipment is 1.1, which is one of the asset accounts. So that will be the first asset account you have to put. And the second one will be cash, because you're using cash to buy other equipment. So that will be, this account is involved too, the 1.9. So which one is the debit and which one is the credit? You're increasing property, plant and equipment. And property, plant and equipment is an asset. An increase of the asset, that's a debit. So you've just identified the debit. That's a PPE. Now we check how much is it. It's 5,000 euro. So 5,000 here, and they're coming from cash. So 5,000 here. Let's go to the next one, which is the 25th of January. Here, the company purchases 3,000 on inventory supplies on account, meaning that the cash will be exchanged later. If you remember from our last video, on account means that the cash will be exchanged later. Because you're buying that on account, that means that you're changing that using accounts payable, which is a liability. So let's see if we find the accounts payable. Here it is. The accounts payable is a type of liability and is the 3.3. So you put that in the accounts payable. The second account that is important to understand is the inventory. So you're using accounts payable to buy inventory. So the second account is inventory. Let's look for that. Inventory is here on 1.7. So you identify the second one, which is inventory, and now let's identify which one is the debit. Inventory is increasing, and inventory is an asset. You can see that here is in the asset family. So inventory is the debit here. How much? Well, that was 3,000. So we write 3,000 on the debit side of the inventory and 3,000 on the accounts payable. And we go to the next one. 27th of January. Here, the company provides a service to client Joe Doe and receives 5,000 as a payment in cash. Well, here you very quickly have to identify that 5,000 increase of cash means that the cash is the debit. Remember that what we do always is first of all identify two accounts. So we can identify first that we're getting cash. So that's the 1.9 that we always talk about, cash. And the second one is we're providing a service. So if you check revenues and expenses, we explained in the last video that services are 4.2. So you put here 4.2 is a kind of revenue, because you give a revenue and you give a service and you receive a revenue. So now if we identify both of them, we know that an increase of cash is a debit, and therefore we put that. So we're talking about 5,000, therefore we put here 5,000, and it's with a service of 5,000 here. Good. That was the 27th. Now let's go to the 28th. The 28th, the company, what I did here is increase a little bit the difficulty so that you go and learn a little bit more. So here the company provides a service to the client Maribu, but doesn't receive the cash immediately. An invoice is sent instead for 2,000 euro. Because you're not receiving the cash immediately, you're doing that on account. However, in this case, you're expecting to get cash. So that's an account receivable. Let's see where the accounts receivable are. If you get and check for that, accounts receivable is a kind of asset and is the 1.8 asset and 1.8. So that's one of the accounts being involved. Which account is the second one? Well, it's the same as before. We're doing a service, so the service would be 4.2, so that will be the second account being taken into account here. Because we're talking about 2,000 euro, we know that an account receivable, which was the asset, and that one is being increased, that is the debit one. So we put here 2,000 euro and in service 2,000 euro. Good. Now we did the 28th. Let's go to the 29th of January. Here the company pays 1,000 euro from inventory supplies bought on the 25th of January. If you remember, the 25th of January we were buying things, but we promised an account, so an accounts payable. Right now we're paying a part of that cash to finalize our debt. So we know that we have two accounts. Let's see and identify them. The company pays 1,000 euro to the accounts payable. So one of the accounts is the accounts payable. Let's see where the accounts payable are. Remember that that was a liability, so we identify that account and we put that here. And because we're paying that with cash, we put that here too. We just identify the two accounts. Now let's see which one is the debit. So where is the increase on asset? If you check it, there is no increase of an asset. We're decreasing the cash and we're increasing we're decreasing the accounts payable. So there is no increase of an asset. Is there any increase of an expense? No, neither. So we go to the next line and we check in the equation. Is there a decrease on equity? No. Is there a decrease on liability? Yes. So when we're paying in cash is to decrease the accounts payable. So we're decreasing a liability. We just identified the debit there. So now we just have to say how much we're talking about is 1,000 euro. So we put the 1,000 euro in accounts payable debit and 1,000 euro in the cash. Let's go to the next one. You see that I'm increasing a little bit the difficulty here so that you learn a little bit more. So next one is the 30th of January. Here the company purchases a car and is paying the car 1,000 euro in cash and 7,000 euro with a bank borrowing. Well, if you check here, we're having three different accounts. First, we're purchasing a car, so our property, plant and equipment is being increased. How much? We'll see that now. First, we identify the accounts. The account is 1.1 for property, plant and equipment. You write that here. The next one is cash, because we have cash involved, so you put cash 1.9. And the third one is borrowings from a bank, so you put 3.1 that we used before, and that comes from liabilities. Let me find that, is here. So now that we know which accounts are involved, let's see how much each one is it. They don't tell you, I'm not telling you how much the car is costing you, but I'm telling you how much I'm expecting to pay, which is 1,000 euro in cash and 7,000 euro with a bank. So actually you have the cost of the car. It's 8,000 euro. We'll put that now here. Why do I know that is a debit? Because we're increasing the property, plant and equipment, and therefore we're increasing an asset. So that is the debit. Now, where does it come from? Well, it comes from two different parts. 1,000 from cash and 7,000 from borrowing. You just made your first triple entry. Triple entries are very common, and you just have to make sure that the left side, the debit, equals to the right side, which is the credit. In this case, they are equal, so we're okay. Let's go to the next one. The 2nd of March, the company pays 1,000 euro in rent with cash. So here is again a little bit different. First, we identify the first one, the first account, which is cash. Cash is 1.9, so we put that here. But what and how are we paying that? Well, we're paying that with rent, and that is a kind of expenses. So we put expenses as the second type of account. Now I have to identify which one is the debit and which one is the credit. So because we're paying a 10,000 rent with cash, the cash is decreasing and therefore that is not the debit, and the rent is an expense and that one is increasing. So we just identify the debit with the rent. That one is the 1,000. We have to put that here, 1,000, and then 1,000 in cash. Good. That was the 2nd of March. Let's go to the last two ones. The 3rd of March, the client Maribu finally pays you the 2,000 she owed you. So of course you see here an increase of cash. We remember that that's the 1.9 cash, and you see a decrease on the accounts receivable. Let's see the accounts receivable here. That's an asset, so you write accounts receivable. That's the second one here. Now we have to identify which one is the debit. Well, here is very easy. The cash has been increased. Cash is an asset, so that is the debit. Let's go back and let's note that here it was 2,000, so I put 2,000 in cash coming from accounts receivable. Now the last one, 4th of March. The company pays dividends to the owners for 1,000. So if it pays dividends, we know that one of them is going to be cash. Dividends are usually paid in cash. I forgot to put here in cash. We are going to suppose that they're paying in cash, so we put here in cash. And now, where are the dividends? Well, dividends is a special one, is non-operating ones, if you remember from the last video, and is here on 6.2, finance costs, insert expenses, and dividends to owners. So this is where usually dividends go. So you identify that one, you put it, and you put other expenses. Now to identify which one is the asset, we just see that dividends is an expense. We see that here, and we're increasing an expense, so therefore that is the debit. So as you have seen, the double entry system gives you a lot of information because it doesn't tell you only what was changed, but where did the money come from. So for example, imagine that in the last line, like we were saying before, the dividends weren't paid with cash, but with borrowings instead. Well, you know that information because an accountant will see here, instead of cash, borrowings, which is the, if you remember, 3.1 borrowing. In that case, that would raise some eyebrows because dividends usually are expected to be paid when the company can, not just based on liabilities from what a bank gives you. They usually paid with cash. So that gives you an information that something is fishy there. So accountants use these to understand what and how it's being paid. Well, that is for today. Remember that if you have any questions, shoot them in the comment section below and I will do my best to answer them. And if you like these tutorials, please thumbs up and subscribe. And if you're doing an MBA, check out the links that I put you in the comment sections to the MBA guide, which is a book I wrote with the complete theory and the exercises that you need to memorize for an MBA. Thank you all for watching and see you in the next video. Bye bye.